Hi friends, I promised to make a video about intraday options trading, and now I'm keeping my promise. I believe that cryptocurrency is an interesting asset for intraday trading, although I think this type of trading is more popular on exchanges with limited trading hours, so that you don't get caught in the morning trading opening gaps, as for example on many world exchanges. Trading starts in the morning and ends in the evening. But at night, anything can happen. Popular world exchanges are also off on weekends, and intraday trading allows you to avoid such surprises. But cryptocurrency exchanges trade 24/7, no holidays or weekends, and there are no such risks that I mentioned earlier. But still, let's talk about intraday trading. How it works with options on the AE exchange and how interesting it is for option traders. Let's get started. Cryptocurrencies are highly volatile instruments. 2, 3, 4% intraday is quite possible. For example, today we observe the following. Pay attention to the chart. Bitcoin went from a price of 27,800 at the beginning of the day to 27,300 by nightfall. 500 points, which is 2%. The next morning, Bitcoin started to rise again and rose 1%, but then fell 1%. How to work with these intraday option moves? I'm not going to look at any complex structures. There's no point in them when you decided to do intraday trading. Intraday trading is usually a simple buying or selling of options. You just need to understand which strikes to use. First, it's best to use short options. Weekly series. Such options have the maximum gamma and the maximum rate of price change. In front of me are weekly options. Expiration, day after tomorrow, Bitcoin futures. You could work with other assets with higher volatility. Matic, Doge, especially Doge. It's a meme currency that responds well to news and tweets from Elon Musk. But we're working with Bitcoin, which is also showing good moves. Pay attention to the chart again. The situation is not a good one for the global economy and cryptocurrencies. The war in the Middle East. It's terrible from a human point of view. From an economic point of view, investors are going into protective assets in an attempt to save their funds. What can be done in this situation? Of course, we can't look into the future, but we can make a guess in a short term. There are two ways. Buy put options or sell call options. Let's simulate. I go offline and think. Price 27,800. I can buy put options with strike 27, 26,500, the cheaper ones. In short series, you should buy the cheap ones and sell the expensive ones. An attractive theoretical price is 8 or 39. I buy options with strike 26,500, 1,000 contracts, 1 Bitcoin. Since I'm offline, the price has to be specified manually for the model to come out accurate. Let's say 28,300. And the theoretical price is still wrong, still low. Alright, I return to online mode and everything is recalculated. So the 26,500 strike option went up in price to 34, and the second option also went up in price. In the first case, we would earn 4 times more. In the second case, we would earn 3 times more. Now let's consider selling call options. For example, call options with strike 28. I turn off the online mode. The price was 27,800. And at a time, the call options were worth 180. Let's say we sell 1,000 contracts. The margin requirements are very different this time. 5,180 is a very high requirement. And now let's imagine the price has gone down to 27,300. I turn the online mode on and off so that the data is updated. Now the price has become 50. The profit is $130. But if we had bought put options with a strike of 27, we would have made a profit of $80–90, excluding the commission. In terms of profit, selling call options is more profitable but there are more risks. For example, with purchased put options with strike 27, we would earn $83 of profit, but the margin requirements would be only $170. So it is more profitable to buy. Risk is lower, margin requirements are low. Next, the current price is 27,380. Suppose that at the current price I buy call options, something cheap. For example, strike 28,500 options are only $15. Or call options at strike 28 are worth $63. Let's memorize those numbers. Now let's say the price goes back up to 27,600. Waiting for the price to recalculate. Done. And now we see that the options have gone up in price a lot. Call options at strike 28 have tripled in price. Options at strike 28,500 have doubled in price. Once the options have gone up in price, we should sell them immediately. The risk is small because our options are cheap. Each time we try to earn 2 or 3 times the premium of the options we bought. If the price went the other way and we didn't guess the direction, it's no big deal. The profit-loss ratio is 3-to-1 or 2-to-1. Because we made a mistake, we can only lose the premium we paid for the options we bought. The delta and gamma charts can also be your reference points. Let's turn our attention to call options with strike 28 or 27,500. The delta is 0.43 and the theoretical option price is 205. If the asset price changes, for example, by 500 points, the option price will change by 215 points. The option will become twice as expensive. Now let's work with strike 28. The theoretical price of this option is 59 points. What happens if there is a price movement of 500 points? The price of the option will increase by 1.5 times, or you can watch the delta. But remember that it changes easily and constantly. For example, if the option 27,500 moves 500 points, the price will be the same as the option with strike 27. The delta should be looked at as a percentage of the initial option price. The cheaper an option is, and the higher its delta, the more profitable it is to buy it. It may happen that a cheap option goes up 3 times in price, while an expensive option goes up only 2 times. Therefore, keep a close eye on the delta. For profitable intraday trading, it is better to use short series. For example, let's remember the theoretical price of these two options, 14 and 59. How much will they gain if the price rises to the 28th level? The option went up 7 times, and the second one has gone up almost 9 times. The P&L of this purchase would be $239. The option has gone up by almost 10 times. Intraday option trading can be very profitable. The AE terminal has all the features to build a strategy that will fit your price scenarios. Web terminal, desktop terminal. Here you can easily change the price, for example, 28, and look at the theoretical price. Choose a cheap call option. If there is a rise, the call option. If falling, the put option. Model your strategies in the options chart. I'm going back online. And then drag and drop the options you're interested in. I click on the T price button so that the prices change to the theoretical prices. I continue the simulation. I enter a price of 28,000. And it is immediately clear how much the options will be worth when the price of the asset moves. Or another option had a price of 47, became 269. The profit is $222. And on the P&L chart, the strategy looks like this. So here you go. I wish you successful intraday options trading. Ask your questions in the comments, leave a like, and goodbye.